Hi everyone, it's Christine Kopr, realtor with Sotheby's Realty in downtown Vancouver. And today Jacqueline Zerbe is joining me with Total Mortgage. For those of you that don't know, Jackie works on a father and daughter son team. Oh my God.
No sons in this team. It's just me.
You know what? We're just going to keep recording because that just makes it more interesting, doesn't it? A father and daughter team. They're both mortgage brokers. And for those of you that may not know the difference, you might be working with your bank, TD, CIBC, etc. When you go to the bank, you talk to them about your mortgage products. They can only sell you their products. If you didn't know, each bank or lender has different rules. And so different products can work differently for you. So when you work with a mortgage broker, they can actually take your personal situation and put it in front of various lenders versus when you go to your bank, you can only work with that lender. And today, Jackie's one of our favorite brokers that we work with. Lots of our clients have had unbelievable success with her. And we thought we'd take a moment to discuss what's happening in the marketplace regarding interest rates. So Jackie, where are we today with interest rates?
Awesome. Thanks so much for having me, Christine. So everybody's been watching the market the last few months, and I get a lot of frantic phone calls saying, what's going on? The sky's falling. And I'm here to tell everybody to just take a deep breath and calm down. So yes, no doubt, we've seen interest rates increasing over the last few months. I'll give you an example. Today, if you're looking at a variable rate mortgage, if you have 20% down at least, you're looking at a variable rate of around 2.7%, give or take. Different lenders will vary slightly. If you're looking at a 5-year fixed rate, you're looking at about a 4.5% 5-year fixed rate. So that's quite a big difference. Now, as an example, if you were to have a $500,000 mortgage, on the variable, your monthly payment would be about $2,025 a month for $500,000. On that fixed rate, it would be about $2,520. So that's a difference of $495 a month. Now, if we backtrack to about 4 or 5 months ago, maybe about January, you were looking at variable rates at about 2.2 versus right now 2.7, so 0.5% difference. Fixed rates back in January were nice and low, 2.84. We were extremely spoiled. So yeah, there's a little bit of concern that people are thinking, well, that 4.5%, that's super high. Yes, it is high compared to what we've been used to the last few years, but history has shown us that we've been very spoiled the last decade because we're so used to seeing these super low rates. So Christine, you want to bring up that graph from the Bank of Canada?
Yeah, you bet. Thank you so much. Okay.
So over here, we're looking at a few different rates. The red line represents the 5-year posted conventional mortgage. So that's not the actual discounted rate you're getting. That's the average posted or benchmark rate that the lenders are providing. And then you get a discount beneath that. They've also highlighted the 3-year fixed rate in green and the 1-year fixed rate in yellow. And then at the bottom there, you'll see the blue line as the prime interest rate. So when you're getting your mortgage, you're always going to get the posted less a discount or prime less a discount. So over here on the graph, we can see right now it's taking you back to about 2002. And if you want, we can look all the way back pre-80s, and you'll if you
oh yeah, well, let's check that out. Let's go. Everyone always talks about the 80s interest rates, right? When interest rates hit 20 or prime rate hit 20%.
Whenever you talk to your folks or your grandparents, I remember when I had a mortgage at 22%. That's because it actually happened back in the day. So now the governments worldwide are super sophisticated and they monitor everything from imports, exports, unemployment, employment, oil, lumber, all that jazz. So the Bank of Canada, they meet 8 times a year and they make an interest rate announcement. And that impacts the overnight lending rate, which in turn impacts the prime interest rate. And that affects variable rate mortgages or lines of credit. Okay.
Can I jump in for just 1 second?
Yeah.
So we've had very low prime rate here. And as we let's just get more into what's happened in more recent times here. So we've been sitting at is this correct? We've been sitting at a prime rate of 2.45.
Yes.
Okay, and today we're sitting at a prime rate of 3.2.
Yes.
Okay, so when
Correct.
the Bank of Canada did their last announcement, I think back in last month, right? In the middle of the month, and they went up by 50 basis points, so 0.5%. That took us to a 3.2% interest rate for
Exactly.
prime.
It was at 2.7, and back in March, they increased it by a quarter point. So
There we
before,
go.
exactly. So this year already, the Bank of Canada has increased the prime rate by 0.75%.
Okay, and so with the variable rate mortgages that you were talking about, you're saying that you can get 2.7, even though it's showing here 3.2. Can you help me understand that better?
Yes, so I'm talking about the discount beneath the prime rate.
Got
So
it. Discount.
exactly. So currently the prime rate is 3.2. If you had a conventional mortgage, in other words, you're putting down 20%, you would probably be getting a variable rate of prime minus 0.5. So that's 2.7. If
Got
you're
it.
putting down less than 20%, discount is going to be bigger, closer to 0.95. So you're actually going to be looking at about a 2.25% variable rate mortgage. Now that sounds attractive, but remember, if you're putting down less than 20%, one, you have to pay a mortgage insurance premium that gets rolled into the mortgage. And two, the maximum amortization is 25 years. So cash flow wise, your payments are going to be higher, but on the flip side, you're going to pay your mortgage off faster. As opposed to if you're putting down 20%, you can amortize up to 30 years. So your cash flow might be a little bit easier.
Right. Okay. So clearly, for those of you that are listening and tuning in with us here today, there's a lot of differences, and the math might even go a little bit over your head. The main thing to take away from this, though, is today, if you were to go and try to get a mortgage, you're probably, is it true? We're looking at 4.5%, because I think back on the 5-year here, it looked a little bit lower. But if I want to go get a mortgage today, 5-year fixed, because I thought, you know what, I want to sleep better at night. I don't want to have to worry about what interest rates are going to be in 5 years. Today, putting 20% down, I'm looking at 4.5%. And that's after the discount or before the discount?
That's after the discount. So there's quite a large spread between fixed and variable rates right now. So a lot of my clients are saying to me, I'm not sure if I want to go fixed because it's significantly higher than the last time I took out a mortgage, or if I'm a first time home buyer, I'm nervous about paying so much. I'm used to seeing rates in the 2 or 3%. So it's a bit of a reality check that if you want to go fixed, yeah, you have to be prepared to pay that higher interest rate. 4.5% is actually quite a normal rate. We've just been very spoiled the last 15 years. And we can thank the subprime meltdown that happened in 2008, because ever since then, we started to see these super low rates. Now they're starting to normalize. Now, I will say you have to keep in mind that the Bank of Canada, or not the bank, the government of Canada changed the mortgage rules so that if you go for a fixed rate mortgage, you have to qualify at 2% higher than your actual rate. So if you're sitting at 4.5% on your contract rate, you have to qualify at 6.5%. So your buying power is reducing, or shrinking as fixed rates are going up. If you take a variable rate mortgage, you qualify at the 5-year benchmark rate, which is 5.25%. So you can see 5.25% as a qualifying rate is much lower than 6.5%.
Right. Right. So then, in terms of looking at purchasing a property today, you could actually get more lending from the bank, because if you go with the variable rate, you're qualifying at a lower qualifying rate. And then for those of you who aren't familiar with the qualifying rate, one of the things that the government decided to do was input this qualifying rate. So basically the premise is the government says, if you're going to take out a mortgage, and this has happened to everybody right now, and it has been since January 1st of 2018, you're taking out a mortgage at 4.5% today, they actually want to make sure that you could carry payments at 6.5% in the future when your mortgage renews. And that's how much money you're going to be capped at when you're borrowing for your mortgages. So it's kind of a built-in safety protocol, because they have been predicting that rates are going to go up. So moral of the story right now, and very quickly, I think there's just so much more to talk about, because interest rates are going to impact the market. What's the Bank of Canada going to do? We don't know. They have been speaking very, very hard about raising interest rates, right? Will that impact the market? Yes, it's going to have some impact on the market. We're starting to feel it right now. But does that mean that it's a bad thing for you? No, you need to do the math and you need to think about it. And the other thing, because of that, is you really want to think about, well, if you're wanting to enter the home ownership market or you're in the market, you might want to actually get a rate hold right now, right? Because I think they're talking about making some much larger interest rate increases in the near term future.
I think it's a good idea to get a rate hold secured for the next 4 months, just so that you have the peace of mind knowing that you've got a good discounted rate secured and you can take your time and focus on the fun stuff, the house hunting, or if you're going to be doing a refinance because you want to renovate your home, secure the money. You don't have to actually fund the mortgage yet. Just put it on hold while you do your homework for your reno or your house hunting. Um, the Bank of Canada meets 8 times a year and they make their interest rate decision that directly affects variable rate mortgages and lines of credit because they affect the prime interest rate. So they've had 3 meetings this year already. We know that they've increased the prime interest rate by 0.75%. The next meeting is June 1st. General speculation is that there might be another quarter, maybe even a half a point increase. Now,
I thought I heard that our governor threatened a 0.75% interest rate increase coming.
Oh, wow. Well, the Bank of Canada has to be very careful. So one of my favorite economists, Benjamin Tell, he's the senior economist for CIBC World Markets. And what I like about him is that he breaks things down into easily digestible information for people like you and me. So he came out with an article a couple of weeks ago and he said, yes, the Bank of Canada is being aggressive in raising their rates, and so they should be to curb inflation. However, he believes that 60 to 65% of the cause of inflation is COVID related, and that should be resolved by the middle of next year. So while the bank is being aggressive in increasing rates right now, that's great because it creates a little bit of wiggle room to come back down later. The bank at the same time has to be careful that they don't raise them too aggressively so as to put the country into a recession. So yes, we do predict or we do foresee that there's going to be some increases. I personally don't think they'll be permanent and I don't think they'll be that shocking, but none of us hold a crystal ball, right?
And you know what? I finally went out on video and made a prediction. I didn't think that they were going to increase rates too much or like a 50 basis point. I was wrong. Oh my God, that was embarrassing. I was like, I'm finally going to put myself out there. But here's the point. The point is that they're talking heavy-handed interest rate increases on the variable side. The bond market, which controls you got your fixed term, secure interest rates, they're always higher because it's like an insurance policy that you get this nice fixed rate, right? That's controlled by the bond market. It's already gone up. Like that ship has sailed. And guess what? It keeps getting higher. The variable rate mortgages are controlled by the Bank of Canada and the prime rate. They've been talking a big game. And if they're going to increase it a quarter point, 50 basis points, or 3/4 of a point, which is 0.75%, that's a big move. Do you want to pay for that move? So the point is like, you might be thinking about buying, you might not be thinking about buying, or you've thought about it, but you're not sure what actions you should take or whether you want to do that seriously right now, or you want to refinance your home or take out a line of credit, any of those things. If it was me, I'd say take a rate hold. It doesn't cost you anything. You have it, secure it 90 to 120 days, whether you use it or not, no biggie, but at least you've got that interest rate. Because why make the decision 30, 60 days from now and be paying more than you really need to? And in upcoming video, I'd really like to break down the differences of how much you pay on your principal and interest, depending on where that interest rate lands. And like, it's amazing the differences. So you've got potential or probably an interest rate increase coming. Also, the bank, they need to also impact the market psychology, right? So hopefully they're talking a big game that's going to help curb some of the enthusiasm, and that will help moderate things, because if they really take some heavy-handed actions, they could put the country into a recession. However, that if they do take some big strides, they do have the opportunity to move things down. So you might actually want to think about that, because in the short term, things might change. But if you're buying your home for a roof over your head for the long term, this is not a stock that we're talking about. You're going to be paying off that mortgage. And, you know, by the time we come out on the other side, you have no idea where things could be, right? Like we saw in that graph, like rates go up and down. So just want to take this opportunity to thank Jackie and thank everyone for tuning in. If you have any thoughts about taking any actions, definitely please get in touch with us or talk to Jackie about what your options are. Get a rate hold. I mean, honestly, everyone should just get a rate hold. I'm pretty sure, like, I've got a rolling rate hold going just because you just never know when you're going to want to take some action. Because it doesn't cost you anything, and at least you can be prepared. And her and her team are amazing. So if you have any questions, please reach out to us. Jackie, any final thoughts?
No, thank you so much for having me, Christine. I'm always available for a phone call, or feel free to text or email me if you have a quick question. I'm happy to help.
Awesome. We'll make sure we get all the contact details into the video and so people can connect with us. Thanks, everybody.